Good afternoon, everyone, and thank you so much for joining us today on our first Masterclass for 2023. We really appreciate your time today. Today, I've got two of my esteemed colleagues all the way from the UK joining me here virtually, or joining us virtually, and that is Richard Statley, one of our portfolio managers, and Glyn Owen, our investment director, who's been with Momentum Investment Global Investment Management since 1998. So thank you guys for joining me today. Without further ado, we're going to be covering our 2022 review, give a bit of a 2023 outlook, and Richard is going to then go through our portfolio overview and give a bit of an update on how we're positioning our 5 investment portfolios going forward. If you have any questions, please do not forget to put them in the question and answer box on your screen, because we'll address those at the end of the session. Without further ado, I'm going to hand over straight to Glyn Owen, who's going to take you through the 2020 outlook as well as our 2023 review. Over to you, Glyn. Thanks so much.
Thanks very much, Nats, and good afternoon, everybody. Thank you for joining us. Well, you don't need me to tell you that it was a hugely difficult and challenging year in markets in 2022, and indeed for investors, of course, as a result of that. And there were lots of really extraordinary headwinds, uncertainties, right from the beginning of the year, but going through the year. What I can tell you is that quite a number of those headwinds are abating, they're weakening. And in some cases, they're becoming tailwinds. So in recent weeks, we have become more constructive about markets, and we think there'll be a significantly better year ahead than in 2022. You might say that's not very difficult, but there's still lots of uncertainty. But we do think we'll have a better year all round. If nothing else, valuations have improved really dramatically over the course of the past 12 months. But there are still some uncertainties around, and indeed, markets have had quite a rally. Since the low point in October, the MSCI World Index of Developed Markets is up about 15%. So a little bit of note of caution in the short term, markets might be getting ahead of themselves, but I'll explain more of that as we go through the presentation. But I thought I'd just start with a recap of 2022, which shows you, oops, there's a bit of a delay there, which showed you just how tough it was across all the major asset classes. What this slide shows is the light blue bar all going down with the returns for the calendar year from all the major asset classes. On the left-hand side, MSCI World Index of Developed Equity Markets, then emerging markets, the JP Morgan Global Government Bond Index, then US Treasury inflation protected securities, US government bonds with returns linked to inflation, then investment grade bonds, emerging market debt, gold and commodities. And you can see right across the board, it was a very, very tough year other than commodities. Gold provided modest protection. It didn't lose any money over the course of the year, although it was a fairly volatile ride. But then in the fourth quarter, the dark blue lines above the line, you can see there was a pretty good rally in markets. So there was something of a turnaround and definitely improved conditions. And I go back to what I was saying about some of those big headwinds. They're slowly turning around, in some cases, into tailwinds. And I'll go into that. Just to illustrate, that's just how tough it was in 2022. Well, this chart here, the red line shows the trajectory of the MSCI World Index through the year. And you can see it was a pretty bad year for equities. The other lines there show the similar index, but the trajectory over the preceding 50 years. So last year down 20% or thereabouts in global equities. It was towards the lower end of the range. In times of the year, it was actually the worst period for a long period of time. So it was a tough year. The green line there, the average return over that period, 108%. So it was 28% behind the average. This was tough, although not extreme like the bottom line there was the global financial crisis. That was a catastrophic year, of course. But what was really quite extraordinary was what happened to bond markets. And we seem not to wanting to move on here. So perhaps you can just move that on, Richard. There we are. This is a similar sort of picture. It shows the return trajectory over calendar years for US Treasury bonds, so safest haven asset in the world, US government bonds. The red line there is what happened in 2022. The lines above it, all above it by some margin, but what happened in the previous 50 years. So the average return over that period from US Treasury is 6.5%. Here was a year that we'd not seen in the past 50 years where treasuries fell by 13%. And incidentally, duration was the enemy here. So the longer dated the bond, the longer the maturity, the more damage. US 30-year bonds fell by 33% in the year. Really quite extraordinary what happened. Some due to the very low starting valuations, and some, of course, to what the Fed was doing in terms of monetary policy. But this was where it was really, really tough in 2022. There was no hiding place when your best safe haven asset performs as poorly as this. And of course, the traditional 60-40 equity bond portfolio therefore offered no protection. That's the light blue line there. Normally speaking, bonds, which comprise the 40% of that traditional benchmark, tend to provide some capital protection and preservation when conditions are very tough. And when you get seismic geopolitical events, that just didn't happen in 2022. So it was a really very bad year. Saved it a little bit by the fourth quarter, but still a bad year. You had to diversify. The red line there shows US dollar cash by actually some margin in terms of return and volatility, probably the best asset you could have had through 2022. But gold also, with a bit of volatility, also preserved capital. You needed to be in commodities to make money, although they do add a hell of a lot of volatility to portfolios. So we're always cautious about adding too much commodity exposure. So this just illustrates how tough it was and how important diversification was. It's a key part of our philosophy, always diversify more broadly beyond and within that 60-40 split with equities and bonds. The other important thing in the course of 2022 was the strength of the dollar. So here we've got the dollar's trade-weighted index, which has been on steadily uprising trend for now a decade or more, but particularly sharp, as you can see on the right-hand side, in 2022. Up until the end of September, the dollar trade-weighted index was up about 20%. That's a real significant shift in tightening of financial conditions around the world. Because of course, the dollar is the world reserve currency, so much traded in dollars, and so much debt, so much international debt is in dollars. So if the dollar goes up, it becomes more painful for countries outside the US. So this was a big headwind for markets. You can see there's been quite a sharp reversal in the past 3 months. Since the end of September, the dollar trade-weighted index has fallen by about 10%. So that's an easing of financial conditions. And I'll explain a little bit about what's happening there and what we think is going to happen with the dollar going forward, because that's actually quite a significant factor in terms of how markets will perform, we think. So what was driving all of this? Well, without a shadow of a doubt, I know that the Ukraine war and Putin's invasion was sort of top of the list in the early part of the year for everybody's concern. But the real driver of markets in 2022 was the policy of the Federal Reserve Bank in the US, by far the most important central bank in the world. And just to illustrate the change that occurred in the course of 2022 with the Fed's policy, we've reproduced this chart, which comes from the policymaking committee of the Federal Reserve. It's produced every quarter through the year. Each dot there represents the view of a Fed governor about where interest rates are going to be at certain dates in the future. And this was the meeting that took place in the middle of December. So by that stage, every dot is in a straight line. The Fed governors have all decided that rates are going to be between 4.25% and 4.5%. So that's where they ended up the year. And the subsequent periods show where the Fed governors think rates are going to be end of 2023, 24, 25, and longer term. You can see there's pretty much a broad consensus about 2023, which is that Fed governors think that rates will be no lower than 5%. They think it's likely to end up the year at about 5.25% to 5.5%. And then into 2024, gradually come down, although there's a very wide dispersion of where expectations are, as you can see. Then longer term, getting back towards that 2.5% area, which the Fed would regard as a sort of neutral rate that balances growth against keeping inflation at the 2% target. The other lines there that show what the Fed's thinking was at the previous 3 meetings in the course of 2022. So we need to pinch ourselves to remember what the Fed was thinking in its first meeting of the year that produced this dot plot, March 2022. At that stage, interest rates were still effectively zero in the States, and the Fed did not expect to raise rates more than about 2 to 2.75% by the end of this year. They didn't think rates would rise very much at all in 2022. Well, you know, how wrong could they have been? The green line shows what the next meeting thought in the middle of the year, so ratcheting it up. Then the dark blue line, what they thought in September. Each time the Fed had a big meeting like this quarterly, they ratcheted up their tightening policy, as you can see. And alongside this, incidentally, they introduced quantitative tightening. Instead of quantitative easing, where they were buying assets all the time in the market, they've shifted to quantitative tightening, so they're removing liquidity at the rate, a pretty big rate of $95 billion a month. So annualize that, that's over $1 trillion a year. That's a lot of liquidity being taken out at the same time as they've jacked up these interest rates. Now, the yellow line there shows what the market thinks interest rates are going to be. And you can see there's quite a big disconnect. The market at the moment, the futures are telling us that they think that the Fed will not be raising rates to 5.25%. They think they're going to peak out at about 4.5% to 5% this year. And then by the year end, they're going to get down to probably around about that 4.5% level, perhaps even a little below that, before falling further to about 3% in 2024. There's a little bit of a disconnect at the moment between what the markets are projecting and what the Fed is telling us. And how that plays out is going to be pretty important in the shorter term at the very least. And one of our concerns, that I alluded to earlier about the very short term, is that the market may have got ahead of itself a little bit here. When we get the next Fed governors meeting in early February, it may well be that they stick to this hawkish stance and say, actually, you know, we are going to keep rates at this 5.5% level through the next 12 months. And I think that would cause a bit of a short-term setback in markets. But longer term here, what we can say with some confidence is that rates are going to peak out this year. Now, I will come back to that, but that's a really important turning point. There was no prospect that we could say anything like that during the course of 2022. There was just so much uncertainty. What's been driving the Fed, of course, is what's happened to inflation. And inflation, all central banks around the world, not just the Fed, right through 2021 and into the early part of 2022, were telling us that they thought the surge we were seeing in inflation was going to be transitory. Well, guess what? It hasn't been transitory. It's been a lot more persistent. I'm going to focus on the US here because it's by far and away the most important central bank, the most important economy in the world. And what happens here is going to be reflected right around the world in other central banks' policies, in my view, and also in what happens to markets. So here we've got several indicators of inflation in the US. The one that the steepest rise there and the sharpest fall recently is the producer price index. So that's showing the price that factory gate from producers went through the roof, getting towards 20% at the peak, much higher than anything we've seen if we go back further than this for 40 years. They've come down very sharply. We have some numbers overnight which are not reflected in this chart, which show a further drop to just over 6% here, a very sharp fall in producer prices, and we think that's going to continue through the course of this year. And I'll explain why we think that is the case. The bigger question is, what happens to sort of core measures of inflation? So the US core CPI, which didn't rise as sharply as headline CPI, because that contains energy and food. We know that those prices have surged. But what happens to the core bit, which tends to contain sort of stickier items of inflation? It's going to fall, we think, but probably more slowly. And then core PCE, which stands for personal consumption expenditure, that's a measure that the Fed watches most closely. That's still running at about, well, just under 5%, 4.7% currently. The Fed target for that is to get that down to 2%. So the Fed at the moment is concentrating very much on those stickier components. I think we can all accept that inflation, headline inflation, is going to continue to fall, and probably quite sharply through base effects and other things that I'll explain. So the big question is how quickly will it return to that 2% target? There's a great deal of uncertainty about that. We think it'll fall quite quickly in the early months of this year, and then it'll take some time, probably into 2024, before it gets down to that 2% target. But it will get there again. There are plenty of people around saying it won't. We don't believe that. So what's happened to give us some confidence about that? Well, commodity prices have fallen very sharply. There was this great surge in in pretty much all commodity prices. Well, it started to happen actually before the Russian invasion of Ukraine, and then surged further for all the reasons we know about when Russia invaded Ukraine. Particularly in Europe, it was very damaging indeed. Natural gas prices went absolutely through the roof because Europe is so heavily dependent on Russian gas. But what's happened, generally speaking, since that initial surge of inflation on the invasion, all those commodity prices have come down. Sharp falls in the wheat price. Everybody thought there'd be a global shortage of wheat. It hasn't happened. The oil prices come down a long way. Iron ore, actually well below the peaks, pre-pandemic peaks. Copper. And if we show natural gas prices here in Europe, they have absolutely collapsed. They went through the roof, in fairness, particularly when Europe was refilling its gas storage capacity through the Northern Hemisphere summer months. But since then, they've collapsed by about 80%. And the risks of a shortage of natural gas in Europe in this winter period have gone. We're enjoying a pretty mild winter in Europe, so demand for gas is naturally falling as a result of that. There's been some cutback because of those high prices. So there's been a big drop in gas and energy prices right across Europe. That's going to help inflation fall quickly in Europe, and it won't necessarily avoid a recession, but I think it'll make any recession relatively mild in Europe, assuming we do still get into recessionary conditions, which I think we will, but not as tough as people thought. So this is a big plus. There's absolutely no doubt about that. The other thing, when I refer to headwinds turning to tailwinds, this is one area. Supply chains have pretty much returned to normal. There was a great deal of concern in that period of time when we were coming out of the pandemic, the great surge in spending that we saw across large parts of the world, the developed world in particular, resulted in supply shortages because factories have been closed down. And supply chain pressures were absolutely intense. You can see now that dark blue line, how they've collapsed, not quite back to normal levels prevailing prior to the pandemic, but pretty low. And then that Freightot Global Index is the index of container shipping. You can hardly get a container for love or money in the period of peak demand, with the clogging at the big ports, Shanghai in particular. That's all eased, and you've only got to read the reports that are coming from companies that are reporting profits in recent months from around the world, and they're clearly indicating that these supply chain pressures are now being pretty much well behind us. So this is no longer a factor. And incidentally, it's illustrated very clearly by what happened to second-hand car prices. You couldn't buy a new car because there was a shortage of semiconductors, and second-hand car prices went through the roof. Well, now second-hand car prices are falling pretty sharply, and you can now get new cars. If you want a very smart car, you might wait a period of time, but the semiconductor shortage has definitely eased dramatically here, and you are getting now a correction of these price surges that occurred in that post-pandemic boom. The other thing that makes us feel that inflation is going to fall quite sharply is what's happened to money supply. It's a liquidity issue, but what we show here is a measure of money supply that is widely used in the US M2. It's a broad measure of money that's available in the economy. It normally grows by the rate of growth in the economy plus inflation, plus or minus a bit. There was an extraordinary surge in money supply growth, something we've not seen at that sort of pace, about 20 or 27%. We haven't seen it in 50 or 60 years. And of course, that was one of the reasons. There was just so much money around. It was one of the reasons why we had the boom in certain, what I would describe as sort of speculative markets like the crypto markets. There was just simply too much liquidity around. House prices went through the roof. Stock prices went through the roof. Well, we're now seeing something we also haven't seen in reverse. Money supply now is marginally contracting year on year, despite the fact you've had inflation of 8% in the US. So this is a dramatic tightening in supply, and almost inevitably it's going to with a lag put downward pressure on inflation. So that sticky price inflation, ex-food and energy that I talked about earlier, running at 6% or so, we're pretty confident that's going to come down as we get through this year, not back to that 2% level that will take into next year, but definitely coming down. Now, the big question, of course, is the Fed in achieving this success in getting inflation down, which I think it will do. How much damage is it going to cause to the economy? And the Fed has made it clear that it has to slow the economy down to to see inflation coming down. We're already seeing very clear evidence of that, not just in the Fed, but across the world. These are purchasing managers indices from around the world, all the big economies, US, UK, Eurozone, and China. Any number above 50 is in expansionary territory. Any number below 50 is contractionary, and you can see quite clearly that the numbers have all fallen and continue to fall below 50. So there's no doubt the manufactured goods sector is in a tough period here. It's in recessionary conditions. The economy has held up reasonably well because of the services sector, and that's remained fairly resilient, although there are some signs of that weakening off, but still not bad. So, and the other thing I would mention in terms of what's going badly is the housing market. Well, that's inevitable. That's going to decline. The mortgage rate in the US has more than doubled from 3% at the beginning of 2022, the 30-year mortgage rate, to over 6% now. Well, guess what that is doing? It's causing a fall in house building, in house prices, and the broad market housing market index is falling pretty sharply. I would just say one thing about this, though. People say to me, well, doesn't that mean that the banks are getting to the same position as they were in 2007-8? And there's an ability response to that, which is definitely not. This is a more normal cyclical downturn in an overheated housing market. The banks are in a good situation there. The balance sheets are strong, much stronger capital ratios than in 2008. And again, you read all the statements coming out from the banks. They all say the same thing. They can cope with a downturn in the housing market. They've built their balance sheets to withstand it. Same applies here in the UK and Europe, in most parts of the world. So this is not a systemic issue. It's a natural slowdown, but part of the process of the economy slowing and inflation coming down. Against all of that, the US labour market, as it does here in the UK and in Europe, remains very tight. And what this chart shows is the unemployment rate. There was a surge up in the pandemic because a lot of people were laid off in the US. Then, of course, they all got rehired when the US came out of its COVID restrictions. Very low levels. There's been a fall in the participation rate in the US, as there has also here in the UK. So the unemployment rate running at below 4%. Job openings running at more than 6%. So there are more jobs available than there are people that can fill them. And guess what that is doing? It's pushing wage growth up. And look on the left-hand axis, the wage growth is running at over 6%. That's uncomfortable for the Fed. We've got exactly the same thing here. The Bank of England is concerned about the same thing, because this is much more difficult to get down. The only way you really get this down is by getting unemployment up. So the Fed is going to do that. We're going to see the same thing here. We are now seeing job losses beginning to appear. So we do think we're going to get a tougher period here. But one of the big uncertainties is how quickly they can get on top of wage growth. So this is an unusual period of time when we're going into a slowdown. Normally speaking, you have a labour market that was weakening off already. That's not the case. And incidentally, it will help to keep this recession or slowdown relatively mild. So we're not predicting here a dramatic crash in economies and a steep recession, but probably a recession, but a mild one. So the other big thing is that inflation expectations, something else the Fed monitors very, very carefully, have remained very well anchored. In the 70s, when inflation went through the roof, as we've seen this time around, not quite as far this time, back in the 70s, which I remember very well, but inflation expectations have got unhinged, and it makes it a much more difficult job for central banks then to control inflation. This time around, inflation expectations have been pretty well controlled and remain pretty much in the range of the past sort of decade or more. So what this chart shows for the US, Germany, and the UK, inflation expectations 5 years from now for the subsequent 5 years. So it's a very good indicator of longer-term inflation expectations. And despite the surge in inflation we've seen right across US, UK, Europe, expectations have not really risen significantly. They're very much in that sort of 2.5% range, a little bit higher in the UK. But this is important because it's if this becomes unhinged, then you then start to worry. But there's absolutely no sign of that. And indeed, in recent days, really, these figures have come down a little bit further even. So this gives us confidence that we'll get through this without much further movement in interest rates around the world. Now, so essentially what we're looking at here is a peak in interest rates this year, and then a fall in inflation, and a more constructive period for for securities markets, for capital markets, generally speaking. And we're given confidence in that prediction by the fact that all the major markets have become a lot more attractive in terms of valuations in the course of the past 12 months. So this is the nominal yield in red there on US Treasury bonds, so US 10-year bonds. The world's discount rate, I like to call it. This got down to, got at the bottom, I think it was about 1.2%. When you think that long-term inflation in the US is about 2%, that meant the real yield, which is the blue line there, was actually at one stage under 1%. It was less than -1%, so about -1.2%, I think it got down to, Richard, from memory, something like that. But it makes those pretty much uninvestable. You know, why would you want to invest in something which gives you a return of next to nothing, and in real terms, a negative return? Well, now you've had this big jack up in bond yields, you've got yields got to about 4.25 here at the top. They've come down a bit recently with this market rally that I referred to earlier, but real yields have returned to much more investable levels, around about 1.25% or thereabouts, which makes them not necessarily super attractive, but certainly more investable and a good component of multi-asset portfolios. This will now behave as you would expect it to, as the world's safe haven asset with a reasonable yield, and it will be a much more defensive asset to own. We didn't own this sort of thing in that period when real yields and nominal yields were so low. So this is more investable. Credit is also a lot more interesting, we think. This chart here shows the difference in yield between investment grade credit at the bottom there, that dark blue line. The middle line there is emerging market debt, and then high yield debt in red. Shows the difference between the yields on those bonds and US Treasuries. So you can see those spreads have increased, as you'd expect to do when you had the Fed tightening as dramatically as we were. Some concerns about credit risk, of course, but they haven't gone up to levels which you would describe as anything like stress levels. It's important to recognize that the corporate sector, like the household sector that I mentioned earlier when I talked about housing, corporate sector is going into this tough period with balance sheets in pretty good shape. So the yield pickup you're getting now on these bonds, we think, is actually becoming quite interesting, and again can form a useful part of portfolios, particularly for income generation with defensive assets. So this is now an interesting area for us. The yields have come down a little bit recently, so we wouldn't necessarily chase it, but we do think we get opportunities here, something that we'd be adding to. And then equity valuations here, this shows price earnings ratios for all the major markets. These have come down a lot. The big move in equity markets last year was all about valuations coming down. When you got the discount rate going up as sharp as it did, it went from, well, effectively the Fed funds were zero at the beginning of the year. They ended up at the end of the year at 4.5. There was a 4.25% increase in the discount rate. Bond yields rose pretty sharply through the year too. So equity valuations come down. And as you can see against history here, certainly over the past decade, these are looking a lot more interesting. So we wouldn't necessarily be chasing them because of this recovery we've had in markets in recent weeks. But if we do get a setback in markets, which I think is inevitable, that markets never go up in a straight line, then we'd be looking to add risk here in this area, because we are going to then be looking beyond the tough economic period that we've got into the recovery period into 2024. So this is now becoming, from a valuation perspective, really quite interesting. In some parts of the market, really quite attractive. Japan looks cheap to us, parts of the UK, nobody likes the UK at the moment, looks pretty interesting. And within that, there are some very good opportunities in certain sectors, value sectors we like a lot. They tend to be undervalued versus growth. So we'll be diversifying by style, which I think Richard will also talk about, as we always do. And then one comment on currency. We always get asked about what do we think about currencies, and we don't take sort of big positions in currencies. It's very difficult to predict currencies with any great success. And you know, we do have views on currencies, both shorter and longer term, but we're not going to take big positions around currencies. But we do think that this fall we've had in the dollar is likely to continue, not necessarily in the very short term. It might have gone, again, a bit too far too quickly. But what this chart here shows the real effective exchange rates of the major currencies around the world. And anything above that zero line basically shows they are expensive. Anything below shows that they are pretty cheap. The dollar of all the major currencies is really extended in terms of valuation. It doesn't necessarily mean it's going to go down overnight, but most likely what it does mean over the sort of medium term, dollar is likely to come back a little bit. And we think there are some good reasons why it might do that. The other being that the Fed tightened more aggressively than the other central banks through 2022. That pushed the dollar higher. It's almost certainly going to peak out quicker than the Bank of England and the ECB and the Bank of Japan. So that probably will help those other currencies, the yen, euro, and sterling, pick up a little bit against the dollar. And you've got this valuation thing going there too. The Japanese yen looks very cheap to us. There's been some significant moves recently in the yen with the Bank of Japan's policy on keeping the yield on 10-year government bonds at zero. They've begun to ease that a bit and widen the tolerance range that they're allowed to permit. They're almost certainly going to widen that further. And there'll be a return to normality in Japanese bonds, and that's pushing the yen higher and will continue to underpin the yen, we think, and it looks like a pretty cheap currency to us. So there are some opportunities outside the dollar over the course of the next 12 months or so, sort of how we're positioned. And then just as a summary, going through some of the things I've talked about here before handing over to Richard. So we're confident that inflation has peaked and it will fall sharply through 2023. And that means that monetary policy will also peak out. But we do inject a note of caution to this thing because the Fed, because of what I've talked about in terms of sticky inflation and what's happening in the labor market, I think there's a pretty good chance the Fed is going to disappoint the market in a sense by keeping policy tighter for longer. So it'll get to about 5.5 in terms of peak policy rates, but it could well hold at those levels through the rest of this year. Unless the economy really creates us, and that doesn't look as if it's going to happen to us. So a little bit of note of caution in the short term, but the big thing is that the Fed is close to the peak in the policy cycle. And that's a really important turning point in this cycle. It makes us optimistic over the next couple of years for what we can expect out of markets. In terms of growth, there's absolutely no doubt there's a slowdown underway. The recession risks have definitely abated in recent weeks. There's much less risk as a result of what I've talked about with inflation in particular, of a really steep recession, even in Europe, incidentally. I suspect there'll still be a recession of sorts, probably a mild recession, but even in the US, I think that will probably still happen. And incidentally, I haven't showed it, but one of the big indicators is the inverted yield curve. The difference between 2-year and 10-year bonds yields in the US has gone into inverted territory. The 2-year yield's quite a lot higher than 10-year yields. That's a pretty reliable indicator of a recession ahead. And monetary policy, I think, will bear down on that. Monetary policy, remember, works with a lag. But there are no systemic risks. There'll be some casualties on the way. The Fed is tightening still. The liquidity is being withdrawn. There will be some casualties. You could argue crypto is one of those. But these are not systemic. And we don't see banks in any sort of position where they're going to have difficulty in handling higher levels of defaults and a more difficult environment. They're well positioned for that. So we're not worried about systemic risk here. This is not a repeat of 2008, 2009. Household companies enter the period in really good shape as well. So it'll get more difficult. But again, we're entering a difficult period with balance sheets, generally speaking, pretty strong. So that also gives us some comfort and quite a strong labour market too, as I mentioned earlier. The risks, of course, are that core inflation stays high. Headline inflation is not going to stay high, it's coming down. But the core bits that I've talked about, the risk is it stays high. The Fed will then be pretty hawkish still. They're intent on getting the inflation down to that 2% target. There is, of course, a danger of overkill, and I suspect that's probably a slightly bigger risk. And the Fed might push things down too far, and then you get a tougher period in the economy, a recession that could then hit corporate profits harder than the market currently expects. So I wouldn't dismiss that as a risk. It's something we build into our thinking. And of course, the whole issue of geopolitics remains with us. What's Putin going to do next? He's clearly had a disastrous war so far, and in a way, it's become a sort of proxy war between NATO and Russia, which is rather depressing. But I don't think it's going to go beyond the borders of Ukraine. It's going to be a long attritional war. But I think we've now got a really good assessment of the damage that can likely cause to the developed world. You know, the damage is being eased dramatically by what's happening to the shift away from Russian supplies of gas and energy to other sources, and that's happened much quicker than anybody thought. I think I read the other day that Germany's built an LNG thing of a storage facility in about 14 weeks or something that previously would have taken probably several years. So when there's stress in the system, even the most bureaucratic of systems can move pretty quickly. So Putin remains a danger. Ukraine remains a threat, and there will be some concerns still about that. But it's not the same as back in February 2022. And then there are some really significant positives that have come through more recently. Valuation opportunities I alluded to earlier. I wouldn't say that there are some outstanding valuation opportunities in bonds, but they've certainly emerged to come down to levels where the yields are sufficiently attractive to form a meaningful part of our portfolios, something that we wouldn't have thought of for several years in a row, and certain parts of credit now look very interesting to us. The other big thing that's happened in recent weeks, and a surprise to markets, is that China has finally thrown in the towel on its zero COVID policy. You might ask, well, why has it done that? Because it was so intent on, it seems so intent on maintaining that policy. Well, partly because I think of the riots that took place in China, partly because this Omicron version was ripping through the population so dramatically they couldn't control the darn thing anyway. But what it does mean is that China's now going to move to reopening much quicker, some short-term pain, because the numbers of people are getting infected, they amount to literally hundreds of millions. But we all know what's going to happen. Younger people are not going to suffer too much from that, and the economy will recover pretty quickly. There'll be herd immunity fairly quickly. It'll recover. Next year is going to be a much better year for the Chinese economy. We had a really tough year, the worst year for growth in about 50 years. It's now going to return to something like a 5 to 6% growth trajectory for this coming year. On top of the easing from the reopening of COVID, incidentally, China has also pushed back on its tightened regulations on the platform and big tech business, which has been hitting that sector pretty hard for a couple of years. That's now behind us, and they're easing off on their tough measures to drain, to remove the sort of leverage from parts of the huge property development industry. So those two other big areas within China, they'll also ease back on those. So a really big change there, and that's going to actually help the global economy next year. So generally speaking, the risks as we go into this year are in much better balance than they were a year ago. We've got more clarity on the way we can see things evolving, and the foundations are being laid here for recovery ahead. So some caution shorter term, given the fact we've had this big recovery in markets since October, and diversification will remain absolutely vital. It's a key part of what we do, as I mentioned earlier. Again, Richard's going to talk about that now. But the cyclical turn that we see coming calls for us to add into risk assets when we get periods of weakness over the course, which we think we will over the course of the next few weeks and months. With that, I'm going to hand over to Richard.
Glyn, thank you very much. Thank you for joining us, everyone. A couple of quick ideas from me. Difficult and challenging is how Glyn described 2022 at the outset. That was across all asset classes, case in point being US Treasuries, down of the order of 12.5%, 12.5% down for the world's risk-free asset. It really gives you some context on what happened. But, and I could show in a variety of different slides, I've chosen this one, which I'll explain momentarily. We have been here before, don't forget that, we've been here before, and markets have always rebounded previously. That is what this chart is showing, looking at those aforementioned US Treasuries. And what it shows you on the x-axis running left to right, that is the historic returns of Treasuries, and then top to bottom, the y-axis, that is telling you what happened following those periods of negative returns of Treasuries, what happened over the subsequent 12 months, subsequent 24 months, and subsequent 36 months. And I want to start first with the subsequent 36-month return of Treasuries. So what happened in the next 3 years after Treasuries had experienced a negative period? Those are in the green dots. All of the green dots are positive. So there's never been a period where, having underperformed, Treasuries then didn't go on to produce positive nominal returns over the next 3 years. If you turn next to the yellow dots, that's 24 months, 2 years. It's almost exactly the same picture, i.e. it's almost never been the case you haven't made money on US Treasuries subsequent to a period where they have underperformed. And then finally, if you look at the grey dots, so looking quite short term, but obviously we do care about 12 months in the same way we care about the longer term. As you get further into negative territory, you have to go as far as minus 12.5%, as I say, you'll see that those grey dots subsequently are again pretty much all in positive territory. So overwhelmingly, using history as a guide, the suggestion is that we should be looking at more positive returns over the next 12 months, i.e. in 2023. On the next slide, moving on to another big asset class, equity valuations. I think you all know this story reasonably well. PE ratios, what price are you paying relative to the earnings power of that business or group of businesses? They're a really good predictor of future equity returns. And the simple takeaway from this chart is that the grey horizontal bars for a variety of different markets, from the US on the left-hand side, the much talked about S&P 500, all the way through to Asian companies, excluding Japan on the far right-hand side. That horizontal grey bar, that's telling you what the median forward PE has tended to be in each of those markets. And what we want to see is that the red dot, the starting valuation we're paying today, we want that to be as cheap as possible, because, as I say, that is strongly correlated to good returns going forward. And you can see almost across the board, those red dots are beneath the horizontal grey bar. So indeed, most markets are cheap. The US still looks a little bit expensive, but is a lot cheaper now than it was going into 2022. So that again, the story, or the picture I painted for Treasuries looked quite promising looking forward. Here is another promising chart now looking at equities. Finally, another asset class that we're certainly interested in, particularly given its weak performance last year, emerging market debt. What we're looking at here is experiences from major crises affecting emerging market debt. Each of those lines is showing the initial drawdown and then tracking the eventual time to recovery. And it's a little bit hard to pick up because the vodka crisis looks quite similar in colour. But if you look at the thickest, darkest black line, that is showing the experience in 2022. That line is still well underwater. And so we're now looking at the second worst experience for EM debt across these various crises. That, we think, strongly shifts the balance of probability in our favour that this is an asset class that will do well from here on out. We've seen bounce backs from a period of difficulty in those asset classes I've spoken about previously. Look, we've also seen it in our own portfolios, each of which I'll go to describe briefly in a moment. We have a cautious portfolio, a managed growth portfolio. Those are multi-asset portfolios. And then we have two dedicated equity strategies if you really want to focus your attention purely on equities. And each of those, we've looked here at some difficult periods in the 2000s, 2009 up to the experience post-COVID. And here we're looking at what were 24-month returns following those big market crashes. And you can see the columns are all pointing up. They're very strongly up. You tended to get decent returns following tough periods. We've also highlighted with some of those comment boxes that these returns tend to come just as news outlets are predicting the end of the world. It's really negative press comments. So try and not get lured in by those and instead focus on the fact that over time, markets have always tended to go up, meaning a bounce tends to follow a drawdown. Quick reminder, just in terms of our credentials, I'm sure most of you know Glyn and hopefully you know me, but anyway, here's that reminder. Momentum Global Investment Management in London was founded in 1998, so we've been around quite a while now. AUM around 5 billion sterling. Third box there, core focus on multi-asset class funds. As I'm going to show, I think the best way to deliver reliable returns is to look broadly for the best opportunities, because they sometimes appear in areas you wouldn't expect. Finally, there on the far right-hand side, a boutique approach with global backing just means we're smallish, 65 odd people in London. Each of us know the other very well, but nonetheless, we obviously have the backing of the wider Momentum Metropolitan Group, so a very decent balance sheet supporting our activities. Here are those funds then, as I mentioned, 3 multi-asset class funds ranging cautious profile through to a growth profile, 2 pure equity strategies on the right-hand side, meaning they have the highest expected return with commensurately higher risk. One is a sustainable equity strategy. Ask us for information on that if you're interested. The other being a core global equity strategy without that sustainability enhancement, but we can cater therefore for a range of needs. In terms of performance last year, I'm afraid there's no way we could defy gravity and not deliver negative returns. I said at the outset that pretty much all asset classes went down, so did our portfolios, but they nonetheless outperformed. So cautious fund outperformed nettable fees, standard 30/70 equity bond type benchmark outperformed that by 1.2%. The managed fund outperformed 60/40 equity bond composite benchmark by 0.9%. Growth fund outperformed by 1%. The global sustainable equity fund outperformed by 70 basis points, and far right Momentum Global Equity Strategy outperformed by 1.5%. So outperformance on the downside. Let's see if we can deliver outperformance on the upside in 2023, should that be the outcome we get. This is a bit of performance attribution. What you see if you look towards the top where it says in red alpha 2 and a bit %, that means the gross of fees were outperformed by about 2% here in a representative portfolio, the managed strategy, doing the same as the other multi-asset funds. So all these themes are true of our cautious and growth fund as well. Where did that come from? It came from asset allocation. It came predominantly from decisions in fixed income, because we expected yields would have to rise to try to contain inflation, and therefore we were underweight some of the worst performing asset classes like those aforementioned US Treasuries. You'll note there, you can see the red -1 figure under managed selection. Some of our managers, some of our stock selection decisions didn't work out, but we would hope to see better in 2023, and I'll touch on a bit of that momentarily. You outperform over 12-month periods, it builds up into very decent long-term returns. Here comparing against peers and showing that pretty much across the board, our strategies work out as first and second quartile. How do we do that? I said it earlier, I think the key to delivering decent risk-adjusted returns is to look as widely as possible. Possibly other managers will focus just on equities and bonds. We like to add into that many other very liquid asset classes, things like infrastructure, things like commodities. We go a lot deeper than that when you're talking sub-asset classes. We're looking at very niche areas. We have some niche lending programs. We consider things like music royalties. There's a lot of opportunities out there we appraise. Finally then, you want to be diversified by style. That's most important within equity, where you want to have a balance between fast-growing tech companies, let's say, as well as older economy type companies that are trading extremely cheaply. So you want to have some growth, you want to have some value. Indeed, you want to have some quality to benefit from compounding over time of world-class businesses like Microsoft. So having a team that can look as widely as possible for opportunities is how we've delivered that good performance. Looking forward quickly, in terms of asset class views, you'll see that we're pretty constructive at the top here, pretty constructive across equities, fixed income, alternatives, and cash. Drilling into a little bit more detail on each of those. Within equities, we like the UK, we like Japan in particular, and there are some opportunities emerging in emerging markets. Within fixed income, government bonds looking much better value, but we still think better opportunities within investment grade credit, as well as lending to riskier companies, i.e. high yield, and within the emerging complex. Over on the right hand side, then you can see we like a lot of alternative asset classes, but in particular private equity and specialist financial. And finally, as Glyn touched on, we still think the dollar has further to correct, the yen in particular being a potential beneficiary of that. So here is our forward-looking positioning. You can see this in the portfolios today. If you take a look at our fact sheets, I just wanted to touch briefly on some particularly interesting areas. Chinese equities, accessing the world's most populous country, accessing the world's biggest economy on the basis of purchasing power parity. You've got to have access to onshore Chinese equities. We added this position in August. Since then, it's outperformed MSCI AC World by 4%, so something, but not that much maybe. Since Chinese equities bottomed, however, at the end of October, this position's outperformed MSCI AC World, so global equities, by 16%. So some good value coming through there. A similar theme, Asia high yield. We added this in September. This has a meaningful portion in China, as you see in the bottom right-hand table. It's got Chinese debt. It has the debt of property companies in China. Those have really turned around. Since we added this position, it's outperformed global equities by 50%. Since this particular position bottomed, it's outperformed global equities by 100%, so twice 100 plus the 16% global equities have done since that time. So again, doing very well, and we hope more to come this year. Finally, some positions that a few more of you have been talking about already, but that is what we see as very interesting opportunities within digital infrastructure, now easily as important as physical infrastructure. Not only that, but also the battery technology that is facilitating a big switch to electrification in economies, things like electric cars. We think these areas you want to have access to, and they're offering very decent yields today, ranging between 4.5% and 6.8%. So a whirlwind tour there of what the portfolios look like and what we're excited about this year. And with that, I will hand back to Nats to finish the session. Thank you.
Thank you, Richard. Thank you, Glyn, for that insight. Really appreciate that. Richard and Glyn, we had a question regarding the market recovery, I suppose, that we've seen more recently. There's been a hell of a lot of negative news in the media by economists, but we've seen quite a rally. Could you just touch base again on the main drivers around that? I can imagine, of course, the Chinese reopening, a bit of the dollar weakening more recently, of course, inflation expectations and the fact that they've started to come down. If you can cover some of those points, that would be great. Thank you.
Yeah, there's three or four main things, really. I guess I think the biggest is the inflation has fallen more quickly than anticipated, and that's absolutely key. Through most of 2022, inflation was disappointing on the upside, as it were. But in the course of the past 3 months or so, the numbers coming out in the US in particular have been below expectations. The one that came out overnight on the producer price index I mentioned earlier was again quite a bit below expectations. So that's giving the market the feeling that, okay, well, the Fed is not going to have to tighten as much as it says. It's getting inflation under control. We're going to see an earlier peak in Fed funds rate, and then by the end of next year, lower rates than the Fed has been indicating. So that's one really big thing. The other thing is that there's more confidence that we're going to get through this very difficult economic period without a deep recession. I think everybody around the world was predicting a sharp recession in the UK and Europe because of what's happened to energy prices. Those areas are much more vulnerable to what happened in the Ukraine and Russian supplies than the US. So everybody was thinking, well, there's bound to be a deep recession in Europe and the UK. That's looking less likely now. And we've even got some people coming out saying, well, actually, we might get through with a sort of a mildish sort of slowdown. Not entirely convinced about that, but the bottom line is it's not going to be the crash that was potentially on the table. If, for instance, there was such a shortage of gas in Europe that they would have to close down large swathes of German industry, which was on the cards for a period of time. They were preparing for that possibility. So that's also been very important. So more confidence about getting through this difficult economic period without a steep recession. And that has led to this easing of financial conditions. The market's ticked up a bit, bond yields have come down, the dollar's fallen. That's really very important as well, particularly for markets outside the US. And then on top of that, you've had the end to yield, well, not the end, but the beginning of the end of yield curve control in Japan has happened without any dislocation to markets. People have been worrying about that. The process is now underway. And then, as you mentioned earlier, Nats, importantly, China has pretty much eased off on all the things that were causing problems in the last couple of years. The leverage in the property development industry, that's been brought under control. They're easing back on that. They're making finance more readily available again. The big regulatory clamp down on big tech and platforms, that's ended. They've made that very clear. And then you've got the zero COVID policy has been torn up. It's plainly not working. And so you've got this reopening trade that comes through. And the Chinese stock market, as a result of that, is up 20-odd% from the lows. And it's given people confidence that China is going to give a bit of a boost to the global economy through 2023. Remember, it's the second largest economy in the world. So instead of growing at 2 or 3% as it did last year, it's going to grow something around 5 or 6%. Well, that adds quite a bit to global growth generally. So if the rest of the world is in a sharp slowdown, it's being offset to a significant extent by what's happening in China. So all of those things added together have pushed markets ahead. And you probably fair to say that there was such a sharp sell-off in the first 9 months of the year that valuations were getting to levels which were looking pretty interesting. The 10-year bond yield got to about 4.25, which looked quite interesting for the first time in a long time, sort of getting on the cheap side. Credit was actually definitely cheap. We added to our credit positions at that time, in fact. So it created opportunities. A bit of money was put to work and built some confidence in markets, and you've had this run up. So that's really what's driven it. And I would just reiterate my short-term concerns. The markets have got a bit ahead of themselves, I think. There are still some hurdles to overcome. So we're slightly cautious short-term, as I mentioned earlier. But there's no doubt that some of those things that happened have been a very material change, which is not going to be unwound. China is not going to unwind its policies again. The supply chains, the dislocation of that has ended. They're not going to suddenly tighten overnight again. So, we're through some of those things that were really, really big headwinds through last year, but we've just got a few more to get through still in the early months of this year.
Great. Thank you so much, Glenn. That's really insightful. And I think we almost at the end. So just some key takeaways from myself. I think it is clear that from both of you guys have clearly said that diversification is very important going forward. I think that how we employ that, you would have seen by Richard's section, is within our multi-asset funds. Diversification at a manager level is key. Diversification at an investment style perspective is key, combining value, growth with quality. And then, of course, diversification from an asset class perspective, going past bonds, going past equities, and also looking to other areas such as infrastructure, private equity, credits, and the likes. There's a lot of opportunities that ourselves and our asset management team in the UK are looking to take advantage of as and when the opportunities arise. Then, of course, in our equity fund, our global equity fund and our global sustainable equity fund, key things there is the same. Multi-factor, multi-style diversification is what's actually driven really good outperformance of those portfolios, all 5 of those portfolios over the longer term. We'll be in touch. Thank you again for your time. And without further ado, we're all going to sign off. Have a good day.